All right, crypto people, let's look at some charts on Bitcoin for the latest article on Brave New Coin. So this is Brave New Coin's halving countdown estimator. I highly recommend you take a look at it because halving is in 27 days. They have 4 estimations here, and they all essentially boil down to mid-May, May 11th, May 13th. This will adjust slightly depending on hash rate. So if hash rate goes way up, halving will come slightly sooner, but more than likely it'll be here in a month or less. And the reason that's important for miners is because their revenue will decrease dramatically so long as price does not increase to compensate the difference. So if price increases, it's no big deal. If price doesn't increase, what we're probably going to see is a further decline in hash rate initially. That'd be my guess. So this is hash rate and difficulty. Difficulty adjusts every 2016 blocks, or about every 2 weeks. And you can see we had a pretty big drop in hash rate preceding the drop in price. So in general, rises in hash rate are bullish, declines in hash rate is bearish. We also have 4 new ASICs coming this year, at least. And typically what happens is those ASICs are used by the manufacturer before they are shipped. Whether or not that's a prudent business practice is up to you, but that's generally what they do. So that could be what we're seeing here is the manufacturers trying to recoup some cost before shipping them. Now, I don't know if they still do this, but my guess is they do. So that could be why hash rate actually got saved a little bit. Another reason hash rate may be increasing is because difficulty is down from all-time high. I think that's a little less likely. But to see hash rate drop and then price drop dramatically before halving certainly will price out many miners post-halving. Now, if we look at the ASICs available, you can see the ones in the red haven't been released yet. So they're coming in April and May. We'll see if the shipments are delayed because of the coronavirus stuff, or production is delayed. My guess is probably. But overall, these more efficient miners are extremely profitable still, even with prices where they are. So this is at 4 cents per kilowatt hour, which is I think what many miners at scale get, if not cheaper. I mean, some miners get paid to take electricity off the grid. That certainly isn't the majority of them, but it definitely is representative of some of them. So their profitability is even higher than this. But after having, like I said, if price doesn't increase, this profitability will decrease pretty dramatically. If we look at transactions per day and average transaction values in the fill here, transactions per day dropped pretty dramatically around March 12th. Now, I don't know if that's because block times decreased. I don't think so, because the transaction still goes through even if it's delayed. So hash rate was way down before the difficulty adjustment, which caused a rise in unconfirmed transactions, but it shouldn't decrease total transactions per day. So I don't really know what that's about, to be honest. It's pretty odd that another big drop also occurred nearly the same date a year ago. So maybe there's some shenanigans I'm not currently abreast of. That's a bit weird. Certainly not bullish to see transactions make new yearly lows. So it's definitely something to keep an eye on. This could be like a batching efficiency thing that I'm not aware of as well, where exchanges are sending fewer transactions because they're batching them. So there could be some efficiency things here. The whole story isn't exactly black and white, and it won't be, for the history of Bitcoin, you're always going to have to look what's really going on here with the outputs, because as we go along, we should get more and more efficient in transactions than how we send them. And transactions per day, just flat, nothing really to comment on there. You want to see this rising in general if we're bullish. Usually it's followed by rises in price as well. This is the unconfirmed transaction count. You can see around March 16th, we had big spikes, and that was mainly due to both increased block times because of decreased hash rate prior to difficulty adjustment, as well as spikes in volatility. Whenever you see a spike in volatility, you're going to get people either panicking to send to the exchange or sending off the exchange. There's generally a lot more on-chain activity with volatility, either extreme highs or extreme lows. So it's good to actually see this because that means the chain isn't dead. People care about the price. They care about Bitcoin. People are aware of it. I mean, the last thing you want to do is die in the dark if you're a blockchain. So to see a reaction is a good thing in my mind. I mean, it's certainly not bullish that we get up to 55,000, 60,000 unconfirmed transactions, but to see it rise and fall is definitely a good thing. So this is block size in the fill and fees in the line here. You can see fees, this is a weekly average. So fees went up a little bit on March 12th-ish, but not that much on a weekly scale. And they've decreased just as much as they increased. So there's not like a massive scaling issue or congestion. There isn't anything that happened on March 12th has been abated or resolved at this point. It's interesting that block size has such wild variation. This could be due to decreased block times because it's an average of what was happening throughout the week. I always like to look at this because, again, if block sizes aren't near full or full, it just says there's just very little activity. It's generally more bearish. This is April 2018. It's generally more bearish when there is less on-chain activity. It's just that simple. It's really black and white in that sense. So to see block size increasing from lows is a good thing. To see it make new yearly lows, not a great thing, but I think that's related to block times. But I think that if block times were down, block sizes would go up because there'd be more transactions per block. But if transactions per day is way down, like I showed in the previous graph, that could adjust block sizes as well. So in general, you want to see this rising and not falling. Looking at daily active addresses in the fill here and NVT in the line. NVT is an inverse metric of economic utility. So you want to see this decreasing if you're bullish and increasing if you are bearish. We were on like the upper third of the historic NVT, which says we're overbought, and it pulled back significantly. So that's good. That's what you want to see. That says at this point, economic utility of the chain is better priced. Even when you compare it to the historic zone, it's generally probably smack dab in the middle at 60. Anything below 50 or 40 historically is a pretty good indicator of oversold conditions, as in there's more utility than actually what's priced in on the market cap. Looking at daily active addresses, they're down a little bit. Not as much as transactions per day, but they're still, at 8-month highs. So that's bullish from the point of we're not like just dying off again. On-chain activity is what gives the price life at the end of the day. There was actually a decent spike at around 950,000 addresses on the daily basis. So this is the monthly average here. We got near 1 million transaction or daily active addresses around April 7th, which is a bit weird because that's after March 12th, obviously. So I'm not really sure what that was about. That may have been an exchange thing as well. But overall, we've had very few days above 1 million active addresses individually. Certainly only one period where we reached 1 million active addresses on a monthly basis. And that was, at all-time highs. So again, you want to see daily active addresses increasing, NVT decreasing if you're bullish. This is MVRV, another inverse metric of economic utility at the end of the day. That's what it is. You can see historically, this is the buy zone. We tap that buy zone. The Z-score, basically anything below 0 is a buy. Anything above 7 is a sell. All three of these peaks have corresponded with peaks in price, local highs or all-time highs in price, extreme highs in price. One thing I thought was interesting is anytime we do poke below 0, we generally are there for months. We weren't there for months on this occasion. So that gives me a little concern that we will drop back into below 0 zone post-halving and then consolidate further. Something to look for. But in general, this is all buy zone territory historically, in that it's, if you treat this as an oscillator, buy zone, sell zone, it's at the buy zone. Again, based on economic utility, when coins moved relative to market cap, that sort of thing. Here's stock to flow, which is based on new coins minted versus what already exists, basically. And you can get this nice algorithm equation that brings us to 100K from 2021 to 2022. Arguably, it's held pretty well in that it's been above and below, but in general, it's followed the predicted model pretty well. Coming up on halving here, so the flow is going to decrease pretty substantially, and that should theoretically increase the price based on this model. You can see how far down we deviated from the model on the recent drop March 12th. and we sort of recovered back to that point. So again, another buy zone, sell zone, oscillator type thing. You can say this is the expected path, and if it's way above, have to take some caution. If it's way below, look at buys, that sort of thing. This is the HODL wave, or when coins move down the chain. Might look confusing. There's really only one thing I particularly pay attention to, which is spikes in these newer moved coins. So the orange, the warm colors are coins that have moved recently. These are coins that haven't moved in 5 years. You can see this is continually getting larger as far as the slice is concerned. At this point, these are probably coins that are just lost forever or in deep freeze cold storage. Since probably 2019, this slice hasn't really grown that much, but coins that haven't moved since, 2009 or whatever this is are probably just gone forever at this point, is my guess. At least some of them. That's safe to say. So in general, these warm color peaks have corresponded with local highs, all-time highs in price, that sort of thing. Now, we haven't had one, since 2018, basically. We've had these mini peaks, but no big slice. So when I was looking at this, at these previous highs, it didn't tell me that this was overbought or anything like that. Again, if you treat this as an oscillator and you say, if you see this, take caution, we're approaching a decrease in Bitcoin days destroyed is another way you can look at it. In general, that just means people are sending coins to an exchange to sell. All right, let's get to some TA. We've got the Bitfinex open interest. Green is longs, red is shorts. Yearly pivots, VPVR, the 50 and the 200 EMA, volume down here, and RSI, which is an oscillator I just look at to see extreme oversold, extreme overbought, as well as bullish or bearish divergences. So no bullish or bearish divergences here. There's no like momentum shifts that you can see. Here's a good example of a bullish divergence. So you get a lower low in price, higher low in RSI. Didn't get any of that here. We just got an extreme multi-year, multi-month low on March 12th, which is a good sign that we're way oversold. Historically, we don't really get too far below 20 in general on the daily basis. VPVR, this is the line graph, so you're not going to see a wicks on a candle, but it did stab into this VPVR zone. Another reason I really like looking at VPVR because it shows support resistance levels that you may not think about. Obviously we had this massive consolidation here at 3.5, 3.8, whatever it was. But to actually see it on the chart on the volume side, I can say, okay, if we just free fall, there's a good chance we're going to stab into one of these support resistance zones, which is another reason why at 8200, 8100, along with the 200 EMA and the yearly pivot, this is going to be a big zone. I think we're going to need to consolidate at before we move higher. There's been a lot of price history in this zone, which is why there's so much volume here. That's a good thing from a support resistance standpoint. Same thing with 6400. I mean, we're above it now, but to see us stab below it and return above it is certainly more bullish than bearish if we're confirming it as support. But in general, this trend-wise is a garbly mess. We had a golden cross, a death cross, it's just all over the place. There's no real definitive trend. It's just a massive sideways range. Looking at open interest, I didn't realize longs actually got this high on 2 occasions, but they're way down now. I said in the article, if we see shorts rise above longs, that's usually a pretty good sign that we're headed higher instead of lower because of the short squeeze potential. You can see longs were squeezed a little bit here, and they weren't really punished here, I don't think. They maybe got out at break even. You'd have to overlay the price to get like the exact read on that. But there's no massive spike in longs here, which is good, because if there was, then you'd say, well, there's a long squeeze in the making. We're probably going lower. This is a crowded trade, that sort of thing. In general, open interest for longs is way down. Shorts open interest is actually arguably at a multi-year high or multi-month, 12-month high, something like that. So it's good that there's no massive imbalance here. It's certainly net long, but there's no, spike in longs like there was on these 2 occasions. Looking at the cloud again, you use the cloud for trend metrics. So if we're above the cloud, we're bullish. If we're below, we're bearish. In general, we are near the cloud, which is a no trade zone as a rule. The reason it's a no trade zone is because We can go in and out of the cloud repeatedly. We can bounce in and around the cloud. The cloud is an indeterminate trend zone, which is why it's generally a no trade zone, unless you trade this edge to edge thing, which is where price enters the cloud and the target is the opposite edge of the cloud. So we had this drop on March 12th. We had a mean reversion back to the Kijun, which is typically what you see on anything ever for the history of all time. You can see even on February, if you take a look at the article from February I wrote on BTC, I was talking about this drop. So we had a rising wedge, we had this C-clamp, this separation between the Tenkin and the Kijun. Price always wants to mean revert and check the strength of the trend. Sometimes it bounces on the Kijun, most of the time it does, and then you get bullish continuation or bearish continuation. But in general, you always get a return to that mean, and we got that pretty quickly after the drop on March 12th. So if I'm bullish, what am I looking for? I'm looking for price to return above the cloud. I'm looking for the cloud to flip bullish. And that's a decent long entry signal historically, especially with the doubled settings, 2061, 2030. If I'm bearish, I'm looking for price activity below the cloud. I'm looking for rejection at 7.3, 7.2. And then what I'd be looking for is an Adam and Eve situation, possibly down to 5, 5, something like that. So here's the Adam left is the V, and the U would be the next structure to watch for. Another option would be a massive inverted head and shoulders below 3.7. I don't know how likely that is. I think the Adam and Eve is more likely if we're going to flip bearish. The upside of that is once the Eve forms, it has the chance at a bullish reversal around 7.2, 7.3. So this is going to be a key level, I think, for the next couple of weeks. Even if we garble around in this cloud here and then drop down to make the Eve, whatever happens, 7.2, 7.3, definitely a key level to watch as far as a bullish and bearish litmus test. This is a Bitcoin price with the volatility index, the VIX, and correlation to the SPX rolling 30-day. And you can see over time, we're generally not correlated to the S&P or legacy markets. We have periods of high correlation and low correlation, but overall it's all over the place. Recently, since the beginning of the year, we've been extremely highly correlated with the S&P. So to see legacy markets extremely volatile, which is what the VIX measures, volatility, and a high correlation, it's no surprise that we're just following, whatever legacy markets are doing, whether it be oil or S&P or Nikkei or any of the global indices, that sort of thing. In general, any spike in the VIX above 40 has been a decent buy opportunity on the BTC chart. We reached 70 or 80 on the daily move, which is the highest VIX since 2008 global crash. So what I want to see if I'm bullish is VIX coming down below 40 to confirm volatility has quieted a little bit. I want to see S&P correlations wither away to nothing, and then BTC can go on its own path. I think in the interim, until this coronavirus stuff goes away, we'll probably be highly correlated with the S&P. And lastly, just looking at the CME futures, in general, these biannual contracts have been pretty good determiners of trend in that we don't get a higher high and a higher low on the next contract. We did on this contract, which hasn't happened since the contract started in December 2017. So definitely an unusual event. In general, the beginning of the contract sort of sets the mood or the tone for the entirety of the contract. Obviously, that didn't happen here. Another thing I pay attention to is volatility surrounding the expiry dates. We've had so much volatility on March 12th that any ancillary volatility from the expiries, like March 27th, looks like a blip on the chart, looks like nothing. So it's more important to me to pay attention to these rollovers when we're consolidating or flat. Like we were having this, we had this inverted head and shoulders form, and then it took off after the expiry, that sort of thing. That's the stuff I'd watch going forward. And then they added a few more contracts around the halving. I don't think these will pay any bearing or be important at all, really, for price. Just because, again, we were so volatile leading into this that any volatility going forward is going to be peanuts compared to what already happened. So in general, trend-wise, we are all over the place because of the high volatility in a high ranging area. 7.2 is definitely the key area to watch. The 200, the yearly pivot at 8.2, that VPVR zone at 8.2. So consolidating between 7.2 and 8.2 would be what I'd want to see over the next few weeks. I don't think halving is going to be a big price event on the day. In general, the halving effect, the decrease in supply, is a 6-month, 12-month effect. It's not necessarily an immediate or a preceding effect, unless speculators take it over and assume there's going to be a large increase in price because of the decreased supply, which doesn't seem to be the case currently.